Okay. Hello, everyone. My name is Chip Frame. I'm with Nadex, and we have another great webinar for you scheduled today. We have, again, Bob Iaccino and Mike Arnold with us again to talk about spreads with Path Trading Partners. As for their background, they have lots of experience. There's slideshows that tell you all about them. But I know that they have a lot of information to cover, so I'm not even going to share that part with you. But these guys have another webinar next week, Tuesday, December 1st. So we're lucky on that. And if you missed the first one, Nadex has a YouTube channel now. It's under videos where you can catch the first one, and then this one will be up there as well soon to follow. So we're going to try to get the response time a lot quicker on these webinars so you can review or if you missed it. Anyway, make sure to send questions if you have any, and I'll make sure I forward it to Bob and Mike. And enough from me, so let's take it away, Bob and Mike. Here you go.
Thank you, Chip. Thanks again for having us. Thanks to Nadex, and thanks for all of you who are in attendance. This is Nadex Spreads Class 2. This is how Nadex spreads are constructed. This will take more than one class to get through, but one of the things I always like to stress to people is that if you understand the product you're trading, and then you have a method for which to place your opinion onto the market or affect your opinion into the market, you have a method, a disciplined method that tells you how to do that. You have to match those two up. You can't just say, well, wow, you know, binaries are all or nothing, $1 or 99, or however you want to word it. Spreads are floor and ceiling, you know, I can do that. You have to understand the structure of these products, and you also have to understand and have a disciplined method that tells you which product to get in, when to get in. We'll get into some of that as well. Before I get started, I want to read a risk statement, and you guys are going to get bored with me on these risk statements, but something everybody should know is this is not just cover your butt kind of stuff. If you actually read the lines in the risk statement, they're important. One of the things I've had people do over the years is say to me, if you're such a good trader, show us your results. I'm happy to do that, except that may mislead you into thinking that you can get the results I can get. You may get better results. You may get worse results. But different people have different makeup, different emotions, different capital requirements, different capital available, and results can vary. So it's not just cover your butt kind of stuff. This stuff is actually true, so I'm going to read it. This presentation is for information purposes only and does not constitute investment advice, nor an offer, solicitation, or recommendation to acquire or dispose of any investment or to engage in any other transaction. This presentation is not intended for solicitation purposes, but only for use as general information. Here's the important part. All descriptions, examples, and calculations contained in this publication are for illustrative purposes only. The risk of loss in trading can be substantial. One of the great parts we always talk about Nadex products is that your risk is defined prior to you actually hitting the buy or sell button, but if you put a substantial amount of money at risk, you can lose that money. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition. Past performance is not indicative of future results. That's the most interesting line of a risk statement to me. Past performance is not indicative of future results. So Bob, Mike, you guys made a lot of money, so I should listen to you, right? Well, sure. I mean, I want you to listen to us. But it doesn't mean that because I made money today, I'm going to make it tomorrow. All right? That's a very important point. That's what that line means. I made money with a particular method today, so I'm going to triple my risk tomorrow is fake, is a fallacy, it's a myth, and it's stupid. Because your performance yesterday does not apply to your performance today. I ran a fund of funds for years, and we used past performance to vet the managers that we allocated money to. So am I not going against what that last line says? Well, no, I'm not. Because I go into it knowing that just because this past performance was good to spectacular, it does not mean that's going to happen tomorrow. I go into it knowing I can lose every cent that I place at risk tomorrow. This is important. I'm sorry to bore you with that, but quite frankly, I don't care because it's important. Path Trading Partners, we're a trading and education firm. We don't just educate, we also trade, and our mission was to form a trading firm that educates, supports, and backs traders who are committed to probabilities, discipline, and long-term trading success. Mike and I don't care if you made a lot of money yesterday. We care if you made a consistent amount of money over time. This is achieved by following the correct path. We are not high-frequency traders, and we are not day traders. We are a firm that believes in a long-term success in trading, covering time frames dictated to us by products, markets, and price action. We do not try to impose our will on the markets. You might have heard this expression in sports before. Take what the defense gives you, or take what the pitcher is giving you. That's what we do. We take what the market gives us. That's what we try to teach. The least important two slides, Mike's bio and my bio. They may be important to those of you who don't know where we are. I'm sorry, who we are. We're in Chicago. For those of you that don't know who we are, this might be an important slide to you. As Chip mentioned, this is being recorded. It will be posted on YouTube. You can pause it and read this if you want. But needless to say, between the two of us, we have over 45 years of experience, coming up on 46 now. And the two of us have done everything there is to do in this business. So I'll leave this up for a split second. For those of you that actually want to read this on YouTube, I'm not going to talk about myself. We're going to go right into what we're here to tell you guys. So this is essentially the second module in Intro to Nadex Spreads. And this part of the class is focusing on how Nadex spreads are different than trading the underlying. It's important to know what the underlying is. All right, one thing I've known over the years and learned over the years as a trader is that we tend to talk in trader speak and think everybody knows what we're saying. So when I say the underlying, right, I mean the contract that the particular spread, or in traditional markets, options, or in binaries, the binary option. The underlying is the price, the security, commodity, that particular option is priced off of. So if you're trading a US 500 spread, the underlying, or what would be on your screen, on your Nadex screen, the indicative index would be the US 500. That would be the live price of that particular index that's trading, right? Nadex has their own way of calculating their indicative index, essentially US 500 based off of S&P 500 movement. You can go to Nadex's website and see how those are calculated. But the underlying is the contract that the spreads and the options are based off of. Okay? That's what it is. We will begin to look at risk graphs for the underlying and for Nadex spreads. Why are these important? Sometimes it's very important, and you can see things much more clearly when you see a picture and you understand why these things are similar. What we mentioned in the first webinar was that once you get an understanding of Nadex spreads, you're going to have a ridiculously clear knowledge of options overall. And options are based on these risk graphs. When you put together a complicated option strategy, you will want to look at a graph and see if it's the way you intended it to be. So we're going to look at some risk graphs for the underlying and the spreads and make some comparisons that will make sense as we go along. And this is just a brief introduction. We'll get into the advanced concepts of how the spreads are actually constructed later in this class, but it's important to understand the risk profile of the underlying before you actually get to the construction of the spreads. So before we get started learning about Nadex spreads, we need to look at the concept of risk graphs. Risk graphs have two axes, okay? A horizontal axis represents the price of the underlying, okay? For those of you that, I struggled with this, so this is why I'm going to say this. For those of you that don't understand the difference between a horizontal and a vertical line, and again, I struggled with this. Horizontal, think horizon, okay? It's the line that goes from left to right. So it's a horizontal axis representing the price of the underlying, and a vertical axis representing the gain or loss of the trader's position. So essentially, there's two lines, one going up and down, one going left to right. Up and down is the vertical axis, which you can see at the bottom represents the gain or loss of the trader's position. And the one going left to right horizontal axis representing the price of the underlying. So here is a sample risk graph. Where these two lines intersect would be your entry price. You have not made a gain, you have not incurred a loss, and your underlying has not moved in price either. Okay? So here's the vertical axis, which represents, as we mentioned earlier, the gain or loss of your actual spread or options position, and the horizontal axis represents the movement of the underlying. So let's use crude futures, for example. There is a crude oil indicative index in your Nadex platform. That price movement would be represented on this red horizontal line, and the gain or loss in your spread or binary option would be represented on this vertical line. A loss would be below it, a gain would be above it. This is a visual representation of what I just said. So again, you've got the vertical axis, right? When the price of the underlying goes lower, the diagonal line, which you'll see soon on the graph, will be represented here in the bottom left. If the price of the underlying goes higher, it'll be in the bottom right. This does not necessarily represent a gain or a loss in your position. Okay, and by that I mean your spread position or your binary options position. The horizontal part of that does not necessarily represent it, but it's critical in knowing what you're doing, because when you look at the vertical axis, excuse me, axis, I'm going to say axis a few times, I'm sure. When you look at the vertical axis, this is where you get the representation of your gain or your loss in your position. Okay, so the underlying, of course, will dictate whether you have a gain or a loss in your position, but it'll be represented on the vertical axis. Okay. One thing I want to state, and I'm going to say it a bunch of times through this presentation, is that some of these things we're going to go quickly through, and they may seem confusing. They're about as confusing as a comic book when you look at them and watch them over and over again. That's why it's extremely important that, as Chip said, Nadex posts these, and then we'll post it on our website, pathtradingpartners.com, as well, so that you can watch these again and again, because if you don't understand these little bits and pieces, down the road, when we actually attempt to teach you a consistent strategy where you could potentially get to where you want to go, you'll be confused by some of the things that are in that strategy in terms of your analysis of what to do and when to do it. So let's take a look at a long underlying position. Again, this is not a spread, okay? This is a position in the underlying. So you can see price action represented down here in the bottom left. This is what a loss would look like. The underlying is going lower, you are long, right? And the key to that is your maximum gain on the upside here is unlimited, and your maximum loss is limited to the underlying going to zero. So if this were crude oil, okay, you lose the exact amount you spent in an underlying position. Remember, this is not a binary or a spread position. This is a position in the underlying. So if you went into the crude oil futures contract, okay, your maximum loss is if crude oil goes to $0.00, and your maximum gain is unlimited. If crude oil goes to $1 million a barrel, you've made that much money on that trade. So this particular diagonal line shows you your position. So if the underlying is going lower, your position will move down into this bottom left here, because this is simply an underlying graph. This is only a graph showing the underlying, not an option. If the underlying goes higher, your position will be represented by a move into this section here. So what are these other two sections for? Well, you'll see. Again, this is just an underlying. Let's look at a short underlying position. Same situation. If you're short, you want the underlying to go lower. Okay, again, this is not an option, right? So your maximum gain, represented in the top left, is limited to the underlying going to zero. If you sell crude oil at $40, you can only make $40 per contract, right? However, in this particular case, your maximum loss is unlimited. If you sell crude oil at $40 and it goes to $1 million, okay, you're going to lose, what is it, 999, never mind. $960,000 is what you'll lose per contract, right? Good thing I work with numbers. So this is an underlying graph. Again, this is not an option. This just gives you an example of what they look like. Here's a short position that's winning, and then here is a short position that is losing, okay? This, again, is just visual. So now, to start combining these ideas, let's look at Nadex spread terms that apply to what we're going to talk about. Some of this may be review for some of you, but like we like to say, if something is easy, just get through it. If something is hard, review it. Floor price. The floor price of a Nadex spread also referred to as the lower strike price. It is the lower boundary of the spread. Ceiling price is also referred to as the upper strike price. It is the upper boundary of the spread. So if you look at a US 500 Nadex spread that has a range of 2,000 to 2,200, the floor price is 2,000, the ceiling price is 2,200. The lower strike price is 2,000. The upper strike price is 2,200. Long, again, maybe review, but please just bear with me. You're a buyer of the spread. You're wanting the price to increase. Your maximum gain limited by the ceiling. Your maximum loss is contained by the floor. Okay, we've talked about this a lot. I've written about this. This should be pretty rudimentary. Short, you're a seller of the spread. Now remember, well, we'll talk about this in a minute, so I'm not even going to say that. But you're a seller of the spread. You want the price to decrease. Your maximum gain is limited by the floor. Your maximum loss is contained by the ceiling. So if you're short, you're a seller of the spread. You're putting on a short position. Okay? Those are some terms that Mike's going to use in the next few slides. So I'm going to go ahead and mute my mic and hand it over to Mike.
Okay, great, Bob. Thank you very much. So let's keep going, keep elaborating on what Bob just went over. So now we're taking it to the next level. We're going into the concept of a long Nadex spread using our risk graphs again. So we have the same risk graph, and this would assume, based off this one, that you're entering in the middle of this entry price. But your gains are capped. We're going along the spread. The gains are capped by the ceiling price. So if you entered in this middle and the underlying continues to go higher, your gains are capped by the ceiling. Your losses are also capped by the floor. So if you entered here, the underlying kept going down. In Bob's example, let's say crude, you entered it at 40, crude went to 0. You're not going to take the loss all the way down to 0. The loss is going to be capped by the floor price. Now, this all depends on where you enter. That's going to determine your maximum gain, maximum loss. Nadex does a really good job at that with presenting you that information up front before you ever even put on the trade. So, one more time, maximum gain is limited to the ceiling price minus the entry price. If you enter down by the floor, you might have a much higher reward to risk. If you enter closer to the ceiling, you might have a higher risk than reward. But we'll get into that more later. The maximum loss is limited to the entry price minus the floor price. For example, if a trader trades the US 500 spread, the 1900-1930, and enters long at 1915, the maximum loss is 15, the maximum gain is 15. That's captured in this risk graph. And where it levels out, where this line goes from up at a 45-degree angle to a horizontal line, that horizontal line shows you, even as the underlying continues higher, you are capped at your maximum gain. Same on the loss side. It's going down, 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 down. Underlying can keep going lower, but your loss is capped. Let's take a look at the short Nadex spread. So the maximum gain on this side is limited to the entry price minus the floor price. So this is as Bob said, if you're going short the underlying, you're making money as it's going down. The only difference if you're putting on a short Nadex spread is the gain is capped by the floor price. Even if the underlying keeps going lower, your maximum gain is capped. Now, vice versa, if it continues to go higher, if the underlying goes higher, your maximum loss is capped by the ceiling price, where this goes horizontal. Very beneficial. And we went over in our last webinar also why some people say, well, it's great that my loss is capped, but I don't want my gain to be capped. Well, actually, we went over that in the last webinar. You should go review that because it's very helpful to understand why we feel that a lot of traders can benefit from not only their loss being capped, which is very, very beneficial, but also their gain being capped because it puts constraints around you. It makes you analyze a position, it makes you fit a position to a strategy, and it's very beneficial for most traders. Now, for example, in this instance, if the trader trades the US 500 spread, again the 1900-1930 spread, and enters short at 1915, which means they're going to make money if the US 500 goes lower, then the maximum gain is 15, the maximum loss is 15. This, a lot of you probably understand, we're just reviewing it to get everybody on the same page. Some of you might have seen these risk graphs, others might not, but they're very important as we keep going into the more advanced concepts. All right, let's keep this moving. Now we're going to get into some more in-depth options. All right, this part of the class is focusing on how Nadex spreads are constructed. We're going to cover some basic ideas of trading options. This is necessary to understand how an option spread works and thereby understand how a Nadex spread works. It's really beneficial. As much of this as you can grasp, and you may have to watch this multiple times. You know, some people might grasp it quickly. When I first learned options years ago, you know, I had to review concepts a number of times before they really sunk in and before I really understood how the nuances work. But once you get down this basics, and you're going to really learn some cool things coming up that a lot of people really don't teach, and not even regarding Nadex, but just option stuff. So it's going to really round you out as a trader. Once you do understand how these option things can be applied to Nadex and how these spreads work and interact and why they act the way they do, you'll be able to understand how you can best utilize different strategies to take advantage of the behaviors of these spreads. So we're going to cover the option stuff very quickly. And don't worry if you don't understand everything or only get some stuff the first time. That's why this will be posted. You can review it multiple times. Some of these things, it's beneficial if you take some time on your own and draw out these risk graphs and try to assemble them, and it's going to sink in over time. So here's just a long call option, a basic. You can, whether you're trading it, you know, against stocks, or whether you're trading against commodities, or whether you're trading against foreign exchange, you have a long call. We're using a risk graph again. So a long call is similar to purchasing underlying except it has limited risk. Your risk is limited to the amount you paid. So again, if the underlying goes lower, you see where this line goes horizontal, you have capped your risk. However, so the maximum loss is limited to the purchase price and the premium paid. So if you paid $5 for it, you can lose your $5 if you hold it to expiration or if the underlying goes really far down. Now the maximum gain is unlimited. So in the gain side, it, you know, looks like just going long the underlying. The benefit of a call is it caps your loss, like the floor of a Nadex spread. A short call. A short call is similar to shorting the underlying, except it has limited reward and unlimited risk. So if you were in the options market, if you were shorting a call, you would actually collect premium in because you'd be selling somebody else the right. Somebody else would be going long the call. You're going short the call. In this case, you have limited reward, the premium you collected, unlimited risk. So it sort of looks like a short underlying position from a risk perspective. If whatever you shorted keeps going higher and higher, if crude you shorted it at 40 and it goes to 100, you lost $60 a barrel. All right, but you would have got paid something to do that. Maybe you got paid $1 in premium price to do that. So you can somewhat see how the short call, well, this could be like, okay, we're limited, and this is the reward is limited, sort of like the ceiling maybe in a long Nadex spread. So you can start to see, I think some light bulbs might be going off already, how maybe we can combine these two things at different prices and we get a Nadex spread. But before we do that, let's go into the put side. So a long put is similar to shorting the underlying, except it has limited risk. What's the limited risk? Well, you're going to pay for this right. You're going to be buying this option and you're going to have to pay for it. Whether it's $1, $2, whatever it is, you paid for it. Sorry, I just jumped ahead there. So the maximum loss is limited to the purchase price or premium paid. The maximum gain is limited to the underlying trading at 0. Again, things can only go to 0. A lot of people, when they're teaching options, say, you know, especially when you're going long options, a long put, your reward is unlimited. Well, not if you're going to the short side, because things can only go to 0. Nobody's going to pay you if it goes below 0, because it's not going to go to 0. It's going to stop trading before that happens. So again, maximum gain is limited to the underlying trading at 0. Gives you a lot of room, but it's still capped out. Let's take a look at the short put. A short put is similar to purchasing the underlying, except it has limited reward and unlimited risk. So if you're going short the put, somebody's actually going long the put. They're buying that from you, so they're paying you the premium. So you can make that premium. That's the most you can make. So if the underlying keeps going higher and higher and higher, you're in a no-risk situation. You've collected that premium. You're going to keep that premium. However, if it goes down, the maximum loss is capped when the underlying is trading at 0, but you can lose, again, minus your premium collected. So let's say you sold the rights to somebody else for $1 when crude is at 40. Well, if crude goes to 0, you lost $40, except for you collected $1, so you really lost $39. Okay, so you have unlimited risk. Now, why do we go through the puts and the calls? Because you can trade Nadex spreads both ways. You can trade them long and short. The brilliant thing about Nadex spreads is we only have to look at them as Nadex spreads. We don't have to go through exactly, or is this a call spread or a put spread? And we'll get into more of that in a second. First, let me go through an options insider secret. I was a market maker on multiple exchanges, and there's one thing you learn as a market maker really quick, okay? An insider secret that few traders know except for advanced option traders and option market makers is a long call can equal a long put, and a short call can equal a short put. And that might not make sense to you right away, but we're going to show it to you really clearly. Essentially, the only thing you need to realize is if you're long or short premium. So if I'm long a call, I can be long a put. And if I'm short a call, I can be short a put. Or one other saying, if I'm long something, I paid for the right to do it. That means I'm long premium. I bought something. If I'm short something, I collected premium. And I can convert a call to a put and vice versa. And we can show how this happens via risk graphs. A call can be converted to a put, and a put can be converted to a call. That's what I want you to take away from this one slide. And this is actually sort of really cool, because once you understand this concept, you can impress your friends, families, and everybody else who might not know this.
So I want to touch on real quick, if I could, Mike, before you go to this slide. The word premium is one of those words similar to underlying, right? It's like a trader word. We use it all the time, and people are like, what do you mean premium? Is that the price I paid? Is the price of the option? Wait a minute, I thought there was a strike price. Obviously, you want to use a different word for what you paid for your option than the term strike price, which is used all the time to designate the price that your option is referring to or set at. So premium, the best way to think of premium when a word like that confuses you is if you've ever bought tickets from a ticket broker, okay? The tickets may be $150 for Justin Bieber. I'm not saying I'm going to say just see Justin Bieber. So whoever's about to throw that out in the comments, I'm not seeing Justin Bieber. But let's say the Justin Bieber tickets are $150, but you had to pay $250 to take your kid or your little sister or whatever. The premium you paid is $100, right? The ticket cost $150, that's the strike price, and you paid $250. Okay, now if you sold them for $350, right, you make the premium, right? You keep the premium, anything above the premium rather. So that's a good way to think of premium. When you think about the word premium, don't be intimidated by that word any more than you should be intimidated by these graphs. If the light bulb isn't going off now, it will. Okay, I promise you it will. It does, and it goes off for different people at different times. But just again, like underlying, premium is one of those words that I think sometimes some educators want to oversimplify things and think that, like, well, we can't use this word because they're going to get confused. We don't think you guys are going to get confused when you just relate things to real life. Everything we do in trading relates very well to real life, and it's kind of the core of what we trade. So premium is just a word for what you paid over and above the strike.
All right, great. Thanks, Bob, for clarifying that. So, long premium. We've seen these risk graphs. So if I take a long call graph right here, let's say I'm long a call, and then I short the underlying, it equals a long put. We might be looking at this saying, huh, how does that make sense? Well, if we just look at our risk graph, if I take this upward sloping part, this 45-degree angle of the long call, and I add it to this downward sloping short underlying part, they actually cancel each other out. And this flat area does not change anything but shift the gain or loss up and down on this 45-degree sloping short underlying. So essentially, you are left with this part and the other parts cancel out and go flat. So if I have a long call and I want to turn it into a long put, all I have to do is short the underlying. So if I have a crude 40 call strike price and then I go short crude, I have essentially a long put with a 40 strike price. All right? We've taken long premium and it was initially a call. We did something to the underlying, in this case shorting the underlying, and we turned it into a long put. We could vice versa do the same thing, converting a put back into a call. This is why it's handy to understand these risk graphs, because if you draw stuff out, you can actually somewhat see visually how, since these lines are 45-degree angles, you can add them together and they go flat. That's one of the best ways I learned to look at this, was once I understood the concept of certain things cancel out and go flat, and then other things, the flat line added to an angle line still leaves an angle that just shifts it up and down the axis. It really started to make sense. I started drawing them out for myself, and the light bulb went off. On the flip side, short premium. If we have a short call, which we've collected premium in, somebody else has paid us, and they've gone long the call, we've gone short the call. If I want to convert that into a short put, if I just go long on the underlying, I get a short put. Again, this part on the short call, the 45-degree angle sloping down, if I add that to the 45-degree angle of the long underlying going up, they cancel out and it goes flat. Then all I'm left with is this downward sloping portion for the long underlying, all right, which adds to this horizontal portion, which just all it does is shift it up and down the axis, and I get my short put graph where I still have unlimited loss except where it's capped at 0, and my maximum I can make is the premium I collected. So again, it doesn't matter. If you're short a call, you can change it into a short put. If you're long a call, you can change it into a long put, vice versa. So all I want you to take away from this. Now we're going to get back into our spreads. A spread is an option position that involves having both a long and a short option position of the same type on the same underlying. The primary types of spreads are vertical spreads, horizontal spreads, and diagonal spreads. A vertical spread is used to describe the purchase of one option and the sale of another option where both are the same type and same expiration but have different strike prices. For example, and these are just pure CBOE options on the OEX. So if I were to buy this first one, this lower strike price option, and sell this higher strike price option, which is essentially maybe I bought a crude, let's just go with crude even though this is CBOE, or let's just say Apple. I bought an Apple call. I bought a 100 strike price Apple call and shorted the 110 strike price Apple call. That would be a vertical spread. And you're going to learn how that's essentially a Nadex spread. A horizontal spread is a strategy where the shorter term expiration option is traded against the longer term expiration options having the same strike price but different expiration. It's also called a calendar spread. You won't directly trade these on Nadex, but you can synthetically trade these on Nadex, which is an advanced concept we're not going to get anywhere close to in this webinar, but it's handy to know there's vertical, horizontal, and diagonal spreads. Why is it called a horizontal? Because, remember, as Bob said, the horizontal is the horizon. This is the horizontal. They're listed on these sheets. You're buying one, you're selling another on different months, and it makes a horizontal line. Diagonal spread, again, really quick. A diagonal spread is a combination of a vertical and horizontal spread. It involves different strike prices and different expiration times. So you can see how this forms a diagonal. All right, so now we're September, October. We're buying this one. We're selling this one. It's a complex strategy, but you can sort of synthetically do it with Nadex spreads because you can trade Nadex spreads against each other at different time frames and different strike prices. Just wanted to relay that to you. So if somebody starts talking about these complex spread things that you don't understand how you can do this against the Nadex, they might say, well, it's a diagonal spread. You roughly know what that is. Again, way out of the scope of this webinar. Let's get back to really how this applies to the Nadex spreads. A Nadex spread, a vertical debit bull call spread. So we're long a lower strike call, we're short an upper strike call. So here's long call, remember our risk graph. And our strike price is going to be a lower strike call. For example, in the US 500, you could go long like a 2,000 strike price call. We're then also going to short or go short a higher strike price call, like let's say the 2010. If we do that, because these strike prices are offset, you really get a graph that looks like this. And we've already seen how we're tying this back to a way a Nadex spread looks. So your loss is capped because you're long a call and you can only lose a capped amount, which is essentially the floor price. As it goes up, you continue to make the money. However, at some point it goes flat. Well, why does it go flat? Because your upper strike price, which is where this dotted gray line kicks in, the upper strike price starts heading down at a 45-degree angle. Well, it offsets this uprising 45-degree angle, so it essentially goes flat. So you see these two yellow lines here? They cancel each other out. That's why your ceiling is capped at the upper strike. So all a Nadex, if you're going long in Nadex spread, it's essentially a vertical debit bull call spread. Because you have to pay for it up front because the call price that you're going long with the lower strike price is going to be more expensive than the one you're shorting, so it costs you money to do. But essentially it sets up the same thing that Nadex has done in a brilliant way. Very simply, it's limited your loss and limited your gain.
Honestly, you guys don't have to answer me, but how many of you thought, if you've ever done a Nadex spread, that you were trading a vertical debit bull call spread? I even struggle to say vertical debit bull call spread, but that's what you've been trading if you traded a Nadex spread, is a vertical debit bull call spread. So now again, if you've ever done a Nadex spread trade, very simple. You can only risk so much. I'm sorry, you can only lose so much. You can only make so much. Same thing in a vertical debit call spread. So next time you go to that option trader's house for a beer in his yard, you say, yeah, I normally trade vertical debit bull call spreads. That's what you're doing. So that's why it's so important, again, to know what it is you're doing.
All right. So again, this is a long Nadex spread. Just looks like this previous graph. If you just take over there, which is assembled from these two option positions, here's our long Nadex spread. Now we don't even have to worry about if it's a call, because remember, a call can be converted to a put can be converted to a call, but we don't need to worry about that. They've packaged it up. We call it, in this graph, we're going long a Nadex spread, which means we're buying it somewhere on this graph axis, and our maximum gains capped or maximum loss is limited. It just depends on where we're going long the spread. Let's now look at a vertical debit bear put spread. Same concept. In this instance, you're going long one put and short another put. And I'll go through this a little faster. Again, the two 45-degree angles cancel out up here, but now you're building a short position where you're going to profit if the underlying goes down. So this is as if we shorted a Nadex spread, which means if the underlying goes higher, we are capped. And if we just did this with a option spread, we'd be capped at the upper strike. We couldn't lose more if the underlying kept going higher than the upper strike. And we can only make as much down to the lower strike. Again, assembled from two different puts at different strike prices. Again, you have to pay to put this on. That's why it's a debit bear put spread. If we translate this into Nadex terms, if you take a look at this graph, if you go short a Nadex spread, well, that's what it is. You have to pay to do it. The money's debited from your account based off where you enter, and you also know what your maximum gain is. If the underlying continues lower, at some point you stop gaining and your gain is capped out. However, also if it goes the other way and goes higher, your losses are capped, all depending on where you entered it. So now you know how, if you're going short a Nadex spread, it's essentially a debit put spread. You don't have to worry about that, because the same spreads are the same spreads. You can pick a spread, whether it's the US 500, 2000, 2010, and you can go long or short it. You don't have to worry that it's a call spread or a put spread or how it was assembled. Just know what the graph looks like. The brilliant thing of Nadex.
Part of the reason you want to know what the graph looks like will become clear to all of you in the next two classes. Okay? It will definitely become clear to you in the next two classes. So you'll see when we show you the graphs that as we begin to teach ways where pricing is different at different times, with different length to expiration, with different position in the underlying, with different volatilities, as we start to go into that, the graphs will come into play in a major way. One of the things we said in the first webinar was you will all understand this graph at the end. This is the background of that graph we showed you in that first webinar.
Just for the point of completeness, I'm going to go through this really quick. Credit spreads. So far we've covered debit vertical spreads. They are the debit spreads because they will cost you money to establish the position. If you are trading options directly, you can also put on credit spreads. For example, you can establish a bear call spread and a bull put spread. These spreads credit your account when you put them on. All right. Since this is not a seminar covering all spread types, just the ones applicable to Nadex, we will not be covering them in this class. Just know you can do them, so you can take those same options and just change the strike prices and get credit spreads also. One of the things with Nadex, though, since you know up front, since you're always going to put on the spreads at a debit, you always know if you can put them on and you can never lose more than is in your account. When you do credit spreads in the options world, you can get into situations where, since you're taking in money, you can actually take in a little premium, but if the spread goes the wrong way against you, you actually owe more than you took in, which means they're going to debit your account, and if you don't have the money in that account, you get a margin call. We don't want those. Nadex took care of those for you. Great, so I only know I can take the risk of what's in my account, and I know up front what my risk and reward are. Helps so many types of traders. If we could if we had these products to train traders on repeatedly, we'd have a lot. Years ago, way back when, before Nadex existed, I think we'd have some more successful traders because of the limitations it puts on you in a positive way, especially with risk and especially with only being able to trade what's in your account. All right. As again, all Nadex spreads are debit spreads, meaning when you establish the position, your account will be debited. We are not going to refer to spreads now as call or put spreads, since one of the benefits of the Nadex spreads is there's just one spread type. All right, you're going to go long or short the spread. It doesn't matter how it's constructed now. I just wanted to provide you the background so you saw how they could be constructed, but now we're going back to simple. As a trader, you do not need to build the spread. You need to decide if you are going long or short. Now, there is some decision-making process. There's going to be a wide range of spreads to choose from. So that's going to be the decision-making process. As you get more and more advanced in this and you understand strategies, you're going to understand, well, this strategy, I need to pair this kind of spread in this kind of time frame to take advantage of it. But pretty quick, you're going to know, okay, I'm looking for a long spread. My system or my strategy says go long. So then you're going to know I'm going to go long the spread. Then it's just pairing the right spread in the right time frame to match your strategy. If you're along the spread, you generally want the price of the underlying to increase. If you are short the spread, then you generally want the price to decrease. Why do I say generally? Because there's ways you can be long a spread and really just want it to sit there and capture premium. Same with the short spread. We'll get into that in future classes. Depending on where you put on the spread, there are times when you may want the price to remain flat so you can collect the premium. That's what I already said. The brilliant thing about trading Nadex spreads is they have simplified the whole spread trading process while keeping all the benefits of vertical spreads. So you get all these benefits of constructing these option spreads, but you don't have to worry about how to construct them. You don't have to worry about going to the market maker and saying, what's the best price in this call spread? But okay, well, what if I did it the put spread? What if I did this? What if I did that? You just have to look and choose your strike price. You choose the floor and ceiling prices and the time frames. So this is, if we're going long in Nadex spread again, we could go long in different areas. We could go, and this is with no premiums. I'm stressing that. Right now, there are premiums built into this, and in a next week's webinar, you'll start understanding how premiums affect the price of this graph, because it doesn't look this way until expiration, but we're assuming no premiums at this point for simplification. So if I enter down at the floor price, let's say I'm right entering at the floor price, and I don't have to pay a premium, like 1 second before expiration, which you actually can't do. My maximum gain would be all the way to ceiling price. Maximum loss would virtually be zero. Again, not actually possible. We're dealing with theoretical right now. If we enter in the middle, our maximum loss would be all the way down to the floor price. Our maximum gain would be the ceiling price. And this is assuming no premiums, and we're holding the expiration, which when we get into the Greeks of these spreads and how the spread actually behaves as the underlying goes up or down, you'll understand why I'm oversimplifying it now. If we were entering up near the ceiling price, our max loss is all the way down to the floor. Again, this is if we're going long the spread. And you can enter, this just shows 3 different extremes, the bottom, the top, and the middle. You can enter it anywhere along this axis because it's constantly trading. Short Nadex spread. If we're going short and we're entering up at the ceiling price, we can make our max gain down as the underlying trades towards the floor price. And if it's trading at the floor price at expiration, we make our max gain. If we enter in the middle, our max gain, again, is to the floor price. Our max loss, is if the underlying trades up by the ceiling price and we're holding an expiration, we take our max loss. And if we go short it down at the floor price, we actually have no room for gain, and we can take a max loss up to the ceiling price. Again, Very oversimplified. And this is assuming you're holding them until expiration. And as you're going to realize, you're not always going to hold all your spreads to expiration. You could get in a spread with 2 hours expiration, and you might only hold it for 30 minutes or an hour, depending on what your strategy says, depending on the momentum of the market. You don't need to hold these things through expiration. They're constantly trading. So you can get in it. I could get in it at the ceiling price. Let's say it drops, the market drops like a rock. I may have not made my maximum gain. The underlying is trading way below the floor price, but I want to get out of it early. I want to lock in my profits. So I've made not the theoretical spread maximum gain, but a gain on the spread. And again, in future classes, you'll understand the difference.
So, again, what I want to definitely point out before I go through the conclusion is that a lot of these things look complicated, and they look, I mean, they look like things option guys know. They look like things Mike knows, right? Binary options are options. Nadex spreads are option spreads, or they act like option spreads. They have the characteristics of option spreads. So in this class, we learned about the risk graphs of options, but more importantly, we showed how option vertical spreads are constructed, and we examined how Nadex has simplified the construction of spreads. So a lot of times, all right, so I'm always very cognizant of not sounding like a commercial for Nadex, but this is because one thing that I promise you guys is that over time, as you learn what we're teaching you, okay, as you learn the different qualities of these spreads, you will want to go off and learn how to construct diagonals, okay, and how to construct calendar spreads and the like. But you will always come back to the Nadex spreads as your core product. And I think to a certain degree, that's one of the fallacies that's out there, is that Nadex spreads are, or Nadex products in general, are for beginners, and I'm going to change that. Nadex products are good for beginners. They're great for beginners, but they're great products. And the spread product itself is fantastic. We learned how all Nadex spreads are debit spreads, and we examined different hypothetical entry points for long and short Nadex spreads and looked at the potential gains and losses. Now, in the next webinar, another things I'm always cognizant of and cautious of is that there are people like Raphael, for example, who is familiar with debit spreads. He knows that he's been trading debit spreads, vertical debit spreads, right? But he's in this webinar, he has stayed in this webinar because the review of how these things actually look on a graph is important. Understanding the word premium as part of your language now is important. Understanding the word underlying, what is the underlying? Okay, so in the next session, we will learn how the underlying relationship to the spread affects the pricing. Incredibly important, because there's things in there that you're not looking at that affect the prices of these particular spreads. We'll investigate the concepts of in the money, at the money, and out of the money as related to spreads. Excuse me. And we will examine the intrinsic and extrinsic values, or the inherent versus premium, that a trader is paying to trade the spread. That is when you start to get it all put together in your mind, and you begin to get in the particular point where you can look at these things and say, okay, I can start to look at strategies now. Okay, I can start to understand strategies. That's when the stuff becomes very, very useful, the core that you have. All right. Thank you for the compliments. What percentage of your profits come from Nadex instruments? So RB, again, that is a question that we get all the time. How much do you guys make? If I tell you $1 billion, it doesn't mean you're going to make that. A better question would be, what percentage of my trading is done on Nadex instruments? Okay, and it's at least half at this point. Okay, some months it's more, some months it's less. One of the things I think that people don't understand is that when you're talking about trading products, right? Something that we used to call, it was actually written up by a student of ours, it was called a true trader's outlook. Losing trades are the complementary probability to winning trades. One cannot exist without the other. So without me giving you 10 years of history, and 10 years ago I wasn't trading Nadex products, the data I'd give you would be inaccurate. But more than half of what I trade now on a very regular basis is Nadex products, and more than half of that for me are spreads. Okay? Now I understand RB. RB is saying, I'm not asking you how much you make, I'm asking what portion of your volume is via Nadex. Right now it's more than half of my volume. Fluctuates. Okay, that fluctuates. So hopefully that answered your question. All right. By the way, RB is also thanking us for the foundation. Generally, I really appreciate the kind comments, but I generally won't repeat them any more than I will repeat, like read my bio off to you guys, because it just feels like I'm a bit of a jerk if I'm doing that. So I don't like to do that. But Raphael says, know everything, and this is premium learning. So Raphael's saying he knew everything we talked about, and he's telling the rest of you that this was premium learning, so I feel inclined to mention that. Eric says, when is the next seminar, and how can I get the invite? Nadex will be sending that out. I believe they may have already sent a preliminary out. It's next week, Tuesday. All right, next week, Tuesday is the next free one we're doing. So that'll be, yeah. And then we'll be teaching strategy courses on our website. PathTradingPartners.com is our website. We're going to be launching our spread and our binary courses in December. If you'd like, follow us on Twitter at PathTrading, at Path_trading. Like us on Facebook, and you can visit us on our website as well. We will be doing actual strategy courses, but we did not want to release our courses until we went through the free structures. Okay, we just don't feel that's ethically right to do. If we don't give you guys the full picture of what's happening with the prices, okay, what's happening with the prices when you're trading, if we don't give you the full picture and we just try to dump strategies on you guys, that's like giving you a recipe without teaching you how to chop. If I tell you to chop the chives and you don't know how to chop, your recipe is going to suck. I do a lot of food analogies right now because I'm an Italian fat guy, but I'm not fat. I look pretty good. All right. Do you offer any other learning resources, trading education? If so, where can we access them in addition to these webinars? Again, you see it on the screen now. Thank you for that, Stella. PathTradingPartners.com. You can find our stuff there. And again, we just essentially launched this particular program, partnering with Nadex, and we're extremely happy to do so. And again, the next free webinar, same time next Tuesday, December 1st. But we're going to launch live classes starting December 1st, and then we'll offer some archived classes, and we're going to continue to produce new strategies and updates and educational webinars basically throughout the month. So we're going to continue to do this. But again, unethical to try and get you guys to join our group or purchase a strategy without giving you the structure first. It's just not the right thing to do.
And,
right.
and we want everybody to be an informed trader, whether you ever trade any of our strategies or not. If we can help you guys understand how these things are constructed, especially these classes each week, these free ones build on top of each other. And by the end, whatever strategy you trade or whatever method you trade, the more you can understand about what you're trading, it can only help your trading. It can make you a better trader. Okay, and that's what we're here for, to make you guys a better trader, and by showing you the ins and outs. And again, like the last week's webinar was just like simple digging a big hole in the ground and saying, okay, you know what? This week now we've sort of put the basement in for the structure and a really solid foundation. And then in coming weeks, we're going to be building the primary floor, and then the second floor, and the third floor. So these build on top of each other. And some of you may know this stuff already. Others may have known some of it and just got new insights. But what we're doing is we're baselining it with a very solid foundation. So as we build up each layer on the building, everybody has this amazing solid foundation and can say, you know what, I want to take the elevator up to the top. Or, you know what, I'm happy with getting off the second floor or the third floor. I learned what I had to learn as applied to my strategies, and it's made me a better trader. That's what we're here for.
Eric says, are you in an office near Tasty Trade? Eric, I know who Tasty Trade is, but I don't know where they're at. I actually work out of the West Loop, and Mike is out of the northern suburbs. So if that's near Tasty Trade, then yes. If not, then no. Happy Thanksgiving to you as well, Ted. Happy Thanksgiving to all of you, by the way. I don't tend to notice holidays. I just don't even notice that they're coming up. So, yeah. So happy Thanksgiving to all of you as well. We're happy to stay here throughout questions, but I think probably at this webinar there's not going to be a lot of questions. Either you understood this or you don't necessarily know what to ask based on this. So I think after the next two we'll probably have more questions. Eric, if you want to, thank you, John. I'm around in the city. If you're in the city, Eric, just reach out through Nadex. Reach out to Nadex or send a support email. I mean, I'm always happy to meet up for a cup of coffee with somebody if they're around. If I have time and if they have time, no worries. I always do that. So I'm happy to do it. If anyone's ever down in the West Loop, please let me know. You can always reach us through Path Trading Partners, and you can also reach out to Nadex if you'd like. So, all right, guys, I think we're going to call it. I don't see any other questions coming up. Chip, unless you want us to do anything else, I'm going to turn it back over to you and wish you all a happy Thanksgiving again. Thanks for being here. Be sure to be in Tuesdays, December 1st, because we're going to start going into some stuff that everything basically is built on this foundation. So thank you, Michael.
Thank you, everybody, for attending. Thanks, Bob. Thanks, Chip. Thanks, everybody at Nadex.
Okay, well, thank you, guys. I really appreciate. I think that was an excellent presentation on spreads. And again, just a reminder, it will be on YouTube, the Nadex YouTube channel very shortly. And if you missed the first webinar of Path Trading Partners, it's already there. So, and you can also see you can get to the link from Path Trading Partners website. So anyway, thanks again, and we'll see you here next Tuesday, December 1st, same time, for another great spread webinar. Take care. Thank you.